Hi, sorry about that.
No
Hi,
worries.
good morning.
Good morning. How are you? Thank you so much for joining us.
Of course, happy to do it. You all will just have to bear with me if there's a bit of a dog
No,
walking or
no
barking.
worries.
But I know I'm not the
um,
first to have this experience.
yeah, we've been doing a lot of Zoom calls recently, so kids have popped in, dogs have popped in, no problem at all.
Well,
Um,
I won't even mention the risk of my three teenage boys somehow making some footing noises in the background. So hopefully they will behave for this.
well, thanks so much. We've spoken a lot, but for our audience who isn't too familiar with FinRegLab and your background, would you mind giving us like a brief overview of what you do?
Absolutely. So first of all, thank you, Ian, for inviting me to participate. And it's a lot of fun to be joining you, knowing also who some of the other, I don't know if we can use the term presenters are, but I work closely with Amias at Treasury. And in fact, Amias and I spent a lot of time for at least 4.5 years sitting in the policy side of the Treasury Department, really trying to understand the implications of fintechs and the rise of fintechs, but also importantly, the rise of new types of data and new technologies being used in the provision of financial services and products.
Mhm.
And the punchline for your listeners is we spoke with hundreds of stakeholders, right, with lots of different points of view. But we never really had any independent resource to turn to who could produce for us non-advocacy, independent empirical analysis of some of the questions that we have that are really relevant ultimately for consumers, the economy, and ultimately public policy and how we need to evolve public policy, our rules and our laws that govern the use of tech and data in the financial system. And even outside of the financial system, right? Some of the new entities that aren't banks or depositories. And so when I left Treasury, I spent a fair bit of time talking to my regulatory colleagues who I had worked with to basically put this kind of concept idea in front of them. If I stood up a nonprofit research organization that sought to answer in a fairly sophisticated way some of these pressing questions about technology and data in the financial services, products and services, would they find that valuable? Would they engage? And the answer there was, I mean, without question, yes, there's a lot of interest and a lot of need for this kind of independent research. And so that's what FinRegLab has set out to provide.
That's awesome. Yeah, I think that's super helpful for the entire ecosystem. I think would love to kind of dive into a little bit about, some reports that you published recently. One of the most interesting ones that I've read, I think it came out maybe a month ago, was on disaster-related credit reporting options. So, with everything going on with COVID, how can bureaus and all the stakeholders involved kind of handle the credit reporting side? Do you want to talk a little bit about that and maybe some high-level, insights that you guys have gained from producing the report?
Yeah, happy to share this. And I cannot believe, frankly, it's already been a month since we released the report. And frankly, I was chatting with my team earlier this morning. We're actually going to, well, I'm getting out ahead of us, but we're probably going to be adding an addendum in light of some of the most recent developments in the credit reporting system. But I think it's worth the listeners, for all of us, to pause and think about just how basic and how foundational our credit reporting system is, right? It's not just how much credit do you get, what's your line of credit, how much do you pay for it. It also, for better or for worse, has relevance for employment opportunities. Can I get shelter, right? Can I actually get rent, or can I find a place to rent? And it also is, in many ways, the undergirding that helps to inform and ultimately stimulate our mortgage market, which is one of our biggest aspects of the economy. And when we're going through a crisis of the type that we're going through right now, how consumers and small businesses and their payment activities on their credit and debt obligations are affected by something like a pandemic, right? A big exogenous shock. It really does have ripple effects for the economy, which I think, we all do realize. I think there's another important piece of this too, which is, in fact, I was just listening to a piece on the radio the populations who are being hardest hit in terms of unemployment and job loss are many of the same populations who were struggling to access safe and affordable credit in the first place. And those are women, racial minorities, recent immigrants. And so there's a double, if not triple whammy effect for certain populations in light of what's happening with the economy because of the pandemic. And then, of course, how does that then translate into what's going to be so foundational for coming out of this economic mire that we're in, and that is people are going to need to be able to access credit and rebuild those small businesses and start to, make sure that they are able to access the credit they need for the short term and the long term, even the asset building opportunities like mortgage. And so that context, I think, is a really important piece of this. But having said all that, we do, and many would argue this, and I think rightly so, we also have one of the most efficient credit reporting systems, across the globe. But yet this pandemic is having direct effects on how these different core sectors of the economy are being affected. And so if you just think about credit reporting and you think about the many different participants or actors in the credit reporting system, it's not just the credit bureaus or the third-party credit score generators, FICO and VantageScore. It's also the different sectors. And one of the big ones is obviously, again, mortgage. And there you've got government-backed mortgages. And so you've got a big regulator who has an important role to play in how we assign forbearance or other codes in light of something like this pandemic. In the credit card sector, you've got many different actors. We have auto, and the list goes on. And so each of these entities, whether they're on the furnisher side or the government side, setting the rules around how consumers are both going to get the protections and the accommodations in light of the risk of not being able to pay. And then importantly, how then those codes are going to be used when it comes to something like refinancing a mortgage, which is, again, an important part of our economic engine. Those differences that exist, and frankly existed significantly as the pandemic was hitting, really are creating a fair bit of friction in our credit reporting system. And that's why we really decided to, spend some time looking at how the system works overall. So let me pause there. I've got lots to share with you.
Yeah, I know. I mean, I read the report. It was really insightful, really in depth. I'm probably going to try to link to it.
Yeah, please do.
Yeah, because I think you outlined some scenarios that I thought were interesting. I mean, starting off, I thought it was just interesting from a innovation perspective. It seems like a lot of the impetus for issuing a forbearance and deferment has to come from the customer. Like they have to call in and things like that. Is that scalable? Traditionally, since it's done through phone calls, and is that something that, with a lot of processes moving digitally, is that something that you think might be more efficient if it's done through a digital process?
Yeah, that's a great question. And it's one of the concerns that many consumer advocates have. It's the reality that, well, I didn't sort of elaborate on what the policymakers have done, but most of your listeners know we passed the CARES Act back in March. And it stipulated that if a consumer is in need of an accommodation in terms of meeting their debt or credit obligations, they can call that creditor and request an accommodation that's something that's equivalently a forbearance structure. The CARES Act specifies that the creditor ultimately will reflect on where that consumer is in terms of their payment status. Are they current or are they already 30 days delinquent? And they will use that status and keep that status steady as the status that will be reflected on that credit reporting. The reality, though, is, like me and probably you and many of the listeners, we all have lots of credit obligations. And some of the fair criticism of our credit reporting system is, it's clunky, it's hard to figure out where to go, you don't necessarily know this. And so if you're then in a position where you've got to go and track down and call and really sort of make sure that not only are you getting the accommodation you need, but that the accommodation is reflecting what, was stipulated by the CARES Act. That's a lot of responsibility and onus to put on those individuals. And so, yeah, there are, I think, important questions for us in this moment and going forward. Are there more efficient ways that we could facilitate a consumer who's in distress being able to, sufficiently and efficiently get that accommodation status placed on the different credit obligations they have? Digital is clearly has a lot of appeal, and we spend a lot of time looking at the digitization of information, which I'll talk about in a bit. We also think that there are some important intermediaries in the credit market. Some of the credit counselors, for instance, really can play that conduit role. And, there too, you can see digital platforms as being, having a lot of potential for allowing these intermediaries to facilitate that kind of accommodation request
right.
in a much more efficient way than, consumer by consumer.
Yeah, because they already have the distribution into the consumer base, and they also have the relationship with the bureaus that to actually execute, the desired action too, right?
Absolutely, that's right.
Seems like we're already getting some questions. One of them is just in general, in terms of credit scoring, what part of the process do you think is in most need of innovation?
Oh, goodness. So I'm gonna hop us a little bit, Ian, in the way that I answer this. Some of the things I know we wanted to cover. We have spent a lot of time over the past year and a half, 2 years even, really looking at alternative data. And in particular, we have looked at cash flow information, transaction level data. We really sought to understand how both fintechs themselves and frankly, the fact that banks are sitting on transaction data, at scale, right? They are in many ways sort of the holders of that data. They are the holders of that data, setting aside prepaid card transaction information. And there, I think, looking at alternative data is both meaningful in terms of, if you will, innovation in light of the crises, because of all of the complexity and the interconnectedness and the potential risk of lags in terms of what we're able to understand about consumer and small business credit risk with more traditional underwriting methods. I think cash flow information, which is basically what's in your bank account, is a really promising way to, in this moment, better understand real-time picture of the consumer or the small business's financial wherewithal, right? And so as we're all, very committed to understanding when we're going to be coming out of this crisis, getting real-time information about what is happening at that sort of individual consumer small business level, what's showing up in that transaction activity. Are we starting to see more routine deposits coming in? Indications of ongoing income? Is there the potential start, even if it's small, of a buildup of a cushion, right? A balance in that account? Those types of insights, I think, are going to be really important as we're coming out of the crisis. And again, I might be jumping us a little bit ahead, but I think we're also seeing policymakers and regulators in particular start to recognize and even signal to the financial sector and the broader fintech sector that this data really may be advantageous. So that's where I would go first. To really dig into the questions around the complexity of the credit reporting system, I think that's probably its own sort of separate podcast to really try to.
Yeah, we could probably do another panel on that.
A hierarchy of places to improve, but yeah.
Cool. So actually, another question: are creditors going to survive the amount of forbearance that they've already undertaken / will undertake?
Great question. So this is anecdotal, and we're so in the moment, right? We are at the end of effectively month 2. And so it really feels, it would be premature for me to sort of, with confidence, speculate on that question. Having said that, I do think that lenders, and I'm thinking about some of the data we've seen in the fintech online marketplace segment. At one level, I think the fact that government has taken action and is flushing, doing its best to get funds into the economy directly to individuals, but also importantly to small businesses, and ultimately to the employees of those small businesses through things like the Payroll Protection Act program. I think that in this short-term moment, the data are indicating that is helping in terms of borrowers' abilities to make those payments. Mm-hmm. Having said that, I know that there are fintechs who, and I'm thinking about the fintechs in particular, who, they're seeing significant portions of their portfolios not making those payments. And so, this raises all kinds of important questions around, the capital requirements, the sustainability of non-depository institutions and what they, how do they sort of have the wherewithal to withstand this economic circumstance we're in. I think that really comes back to questions about how long does this pandemic last. I do think that the fact that some of these fintechs really were already in the relationships with many of these consumers and small businesses, but especially the small business piece, means that when they pivoted to be, and they got finally the permission to be a conduit for those PPP funds, that's actually been helpful for them in terms of sustainability of those types of entities.
Right. So it basically gave their business another lifeline since their customers weren't, able to make those payments. They were able to pivot into another business line that was, it can kind of help them weather the storm, so to say.
Yeah, we hope so. I mean, again, it's really early days, and I think we're all waiting to see when does the economy safely pick up, right?
Yeah. And like you said, it's only the end of month 2. I mean, it feels like, I've been at my parents' house, so it feels like a couple months, but in terms of the credit cycle, I saw a CFPB report. We ended up writing about it because I thought it was really interesting data around the drop in credit inquiries. And that was something that I thought was pretty interesting. It seems like, mortgage, I think you mentioned this before, and I wanted to just ask you really quickly, like, what have you been seeing about the mortgage industry? I think refis have been, anecdotally, we spoke to the head of product at Better.com, last month for our first virtual event, and she said that refis were going through the roof for them. I'd love to hear a little bit more about what you guys are seeing on the mortgage side, if anything.
Yeah, that is an important piece of this. We have been, we have these data maybe, and they're pretty recent, but they might be a week or two old. There were a little over 4 million borrowers in forbearance on their mortgages.
Wow.
And as we think about the mortgage market, I think we have to realize there are the government-backed mortgages, and then there are the private mortgages. Mm-hmm. And there have been a lot of concern, especially around where the GSEs are, where the investors will be, if borrowers are struggling to make their mortgage payments, are going into forbearance, are then in a position where they may be seeking to refinance, but depending upon the rules, and frankly, these are changing on the week, depending upon the rules by FHFA, which is the big GSE regulator, on whether or not, or how long someone is or is not in forbearance, whether or not they can then refinance the loans. This is having an effect on especially those government-backed mortgages. On the other hand, rates are low, no question, people would love to refinance. I think you just, this too is probably its own show with you. You've got to drill down and really assess the different mortgage sectors, and even in the non-GSE backed loans, they're the jumbo mortgages, how are they faring relative to the very non-conventional, non-GSE loans? There are important differences even within those subsegments that you got to really think about. But, rates are low, And no question, people are trying to figure out how to potentially squeeze out cash. So they're building up their cash buffer,
Yep.
or also, lock in a much lower rate. But I think the ability to do so really depends.
Yeah, saving a couple $1,000s per year is, can make a big impact for a lot of families. So I think it's something that a lot of people are thinking about. Going back to the payroll protection program, did the loan process and, some of the other CARES Act related benefits for consumers, like the direct disbursements, did they illuminate some issues that you guys at FinRegLab weren't thinking about before? I'd love to hear a little bit more about, some of the changes that you guys have been making around, post-COVID or during COVID, I guess.
Absolutely. So I will say some of the challenges that I think have really sort of shown themselves in the PPP experience are things that were really in front of us and will, continue to be until we really do start to innovate around the type of data that we're using for things like, are you who you say you are, meeting certain identity requirements, either by law or, just as prudent sort of extension of financial services, right? Mitigating fraud risks. And so when PPP hit, I think it is, I think it's not surprising, and there's a lot of logic and reason given the demand for those funds for traditional depositories, the big banks, to focus on getting those monies available efficiently to existing customers. But yet there are a lot of small businesses out there who also were in need of the funds, and without necessarily an existing relationship with those banks, especially the Small Business Administration 7A lenders, the ability to quickly get into that financial relationship, go through this important onboarding process, really, I think, sort of came to light. And again, I don't think it will surprise anybody, but it's often the very small businesses, the sole proprietors, minority-owned businesses, as well as businesses located in underserved communities who have been struggling the most in terms of being able to access those monies. And there's a lot of survey data out there that bears that out. What we have done, and I thank you for asking about this, because we are about to release another research brief that really hones in on some of these onboarding challenges. But what we are doing is really shining a light on some of the technology and data and fintech vendors who are offering and are leveraging new types of data or non-traditional data to help either banks or fintechs themselves verify these small businesses. Are they the small business owners that they purport to be? And so data like data that sits across states, right? Small business incorporation data, registry data, even phone data, both phone registry data, but also the real-time verification process that many of us have participated or used ourselves when opening up a new account. And so we've also looked, I think, importantly, at some of these intermediaries that are Blend as an example, right, that have pivoted to be responsive to the need in the COVID crisis. And they are amassing and pulling in data from lots of different sources in a digital way to really quickly facilitate that onboarding process on behalf of lenders who are trying to facilitate the PPP, whether it's the fintechs or banks themselves. And so we're putting that paper out in the next couple of weeks. Hopefully it will be both instructive should we have another sort of tranche of funding coming out that will be distributed through our financial system. But frankly, I think it's an important piece of how we think about recovery. Like small businesses especially are going to be in need of getting the credit to get back on their feet. They've got to have access to the providers. This is a place where I think fintechs have really shined in the fact, I said this earlier, right? They have many of these relationships already.
Right.
And they played a really important role, both in PPP, but I think they may also be an important actor in the recovery process.
Yeah, I think I think that speaks to a lot of work that you guys are doing, and I think have done in the past. I think I want to talk a little bit more about some of the stuff you've done in the past. So,
Sure.
cash flow underwriting is something that I think about a lot. I'm really fascinated with it. It's something that a lot of non-bank lenders have been implementing over the past couple of years. Where do you think that's headed from a regulatory perspective? I know this is we're getting a little bit outside of COVID, but I mean, it's super interesting to me. I think there's a piece of guidance that came out towards the end of 2019. Can we see some more guidance around that down the line too?
Yeah, definitely. And I would tell your readers or listeners, please do sign up for our newsletter. We're about to talk about some of what's just come out on the regulatory front. Yeah, it's really quickly, I want to give a shout out to the fintechs who participated in the cash flow research that we did. We basically were able to amass loan level data from 5 of 6 fintech lenders who are providing short-term small dollar credit to consumers and small businesses. We evaluated that data for 3 purposes. One, is the data predictive? How does it compare to more traditional underwriting methods? Is it enabling those lenders to serve underserved populations? And 3, an important question for everybody, do the data correlate with protected classes? Are they creating a disparate impact risk? Mm-hmm. And the really encouraging findings, the data are predictive, and in fact, they are actually offering a nuanced difference in credit risk assessment from a FICO or a Vantage insight. Sorry about all of the Slack background.
No worries.
I'm not
It
quite sure how to
happens to
turn
me
that
all
off.
the time, and I can't really figure out how to mute Slack either. So it's a
I
nightmare.
don't know how to mute Slack either. If there's anybody from Slack listening, please tell us how to control the sound. But these lenders are actually also serving populations in low to moderate income communities. And importantly, the data that we evaluated, and again, this is important, from those lenders, not necessarily representative, but nevertheless, the data that we were able to look at were not correlating with protected classes. Right. And that's really important for the regulators.
And I think,
and it's important for,
Oh no, I was just going to say, talking to founders.
Go ahead.
And talking from like the product perspective, looking into, I've, when I've done product consulting in the past, I've spoken to a lot of companies who have looked into like using cash flow underwriting systems and things like that. That's actually really interesting. I think like what we've, a lot of the impetus for using these kind of new data sources to underwrite is because that they want to offer underwriting programs to classes that traditionally don't get them. So I think that having that backed up by some data, I think is really important, that it actually makes a difference too.
And I think that, and so what's exciting about what the regulators did in the fall, and I think this is where we get to claim a little bit of credit, is part of the work that we do is running the research, running the experiment, but also facilitating a dialogue where we invite the regulators to engage and really look and learn in literally our experimentation process, and then also through working groups that we conduct with all of the industry stakeholders. And so the fact that we were engaging both the prudential regulators and the CFPB meant that at the end of this, they were all informed about how we did the research, what the insights and the findings were. And that, I think, helped them get to the point where they could together issue a joint statement. And as somebody who's been in policy for a long time, getting joint statements is a pretty big deal. Mm-hmm. And then more recently,
there was like a couple regulators on that. It was like 5 or 6, right?
It was the prudential regulators, the Fed, the FDIC, the OCC, plus the CFPB. Mm-hmm. And I'm going to embarrass myself by not recalling if the credit union administrator was on too. I can check that for you. But what's really, But what I would point out now to everybody, and we talk about this in the newsletter we're about to release, is the OCC has just put out its principles around small dollar lending, and they call out cash flow data as a particular type of alternative data that they think may be really useful for underwriting small dollar credit. They also call out their, a willingness to encourage partnerships with fintechs and non-banks. And so I think that's great to see. And then BPI, which is the big bank policy research organization, they have just secured the first step towards getting a no action letter from the CFPB in order to also seek this no action letter authority for some of the banks who themselves would use cash flow data in underwriting. And so I think we're really, in part, because the regulators sort of understanding and growing, I think, comfort with this new type of data being used in underwriting, frankly, plus the fact that we are in this pandemic and we are going to need to be able to get a more, quicker real-time assessment of the financial health of potential borrowers. I think we're starting to see more action here by the regulatory community, which is great.
Gotcha. I have one more final question. I know we're a little bit over on time, and,
Sure.
and John and Julie are ready, but I think this is super important. How do you recommend fintech startups engage with FinRegLab?
So please reach out to us. We're still small enough where I will give you my own personal email. It's melissa.koide@finreglab.org. You're also welcome to reach out to our general admin@finreglab.org email, but we'd love to hear from you. We're actually announcing today via our newsletter that we are really turning to look at some of the technologies and the advanced analytics that are being deployed, including AI and in particular machine learning in underwriting. So we'd love to hear from those of you out there who are doing work in that area. Soon enough, we'll actually tell you more about what the research is that we're going to be doing that in many ways will be akin to the cash flow evaluation that we did. So please do reach out to us and do subscribe to the newsletter too.
Yeah, it's I've subscribed and I've been getting a lot of interesting insights from it, and I'll be reaching out too because this is a lot of fun, and I definitely have a lot of questions down the line about regulation and U.S. fintech. So thank you so much for taking the time to talk a little bit about it today.
Absolutely. Thank you, Ian. Good to talk to you too. And thanks everybody for tuning in and listening.
Awesome. Thanks
Take
again.
care.
Bye.
Bye-bye.